Hello traders, this video is about a simple moving average strategy that I utilize, which is based on a 9 and 27 moving average with a few oscillators to assist in decision making. So before we continue with this, please remember, levels are the most important element of trading. Secondly is actual price action. Okay, so you will always do yourself a favor by understanding levels and price action. And you can browse through my videos, you'll see I've got videos on levels and price action. So typically moving averages, oscillators are really just indicators. They are not the key to your decision making. Okay, so just bear that in mind. A lot of times, a lot of traders that just focus on oscillators often get burnt because they get ambushed when price turns around or hits a level rather than adhering to what's going on in these oscillators moving averages. Okay, so this strategy pretty much works across all time frames, although I like to use it for my short-term trading. So for me, that is a 12-minute chart, and my time frame that I use this on are typically a 12 and a 6 minute. Okay, I'll also look at a 3-hour, which is for my long-term levels, and you'll notice that those are all multiples of 3, as are the moving averages. Okay, let's just start with what the chart setup is. So firstly, the green dots, okay, pretty much a parabolic SAR and standard, nothing unique about it. Okay, the moving averages, this blue line here, come on. The blue line is a 9 moving average, and it's a linear weighted moving average. Okay, and the red line is obviously a 27 moving average, and that is also linear weighted. Okay, so both those two moving averages are derived from a combination of the Bill-Williams theory as well as the Ichimoku, Kijinson, and Tekinson. Okay, so those are the first 3 elements. These 2 moving averages here are pretty straightforward. This teal one here is basically a 200 simple moving average, okay, and the purple one is a 200 exponential moving average. These 200 moving averages are really just a level for me. Okay, so it's basically indicating that we have a level, and I'll trade off that. Okay, then down here we've got 2 oscillators. The first one is the Williams percentage R with set to a 15. Okay, so it's a little bit different from the standard. And down the bottom here I have 2 stochastics. Okay, so if we just open the one, so the one is a 9 exponential stochastic, and the other one is a 27 exponential moving average, and slowing, and the percentage D on both is 5. Okay, now the strategy is quite simple. Firstly, what you're looking for is a level, and as I said, I'll look at the 3-hour for a level. So let's just go through the price action here of the last couple of days. You'll see there was my first level, and there was my second level. Okay, so sorry, the arrows you see here are just fractals. Okay, so my charting platform has an indicator that gives me fractals, but if your platform doesn't have it, just do a bit of Googling and you'll see it's pretty easy to understand what a fractal is. It's basically a bar that has a high and then 2 lows on either side, or a bar that has a low and then 2 higher lows on the other side. Okay, or higher highs, should I say. So just have a look for that. It's pretty straightforward to see. You can just see, so you see there's 1, 2, there's my high, 1, 2, my low. If I look at this one, 1, 2, okay, and you're going on the close, not so much the tails, and 1, 2, and that one actually comes into play as well. But anyway, video is not about fractals. I do have a video on fractals for you as well. Okay, so rule of thumb for the levels: look to the left, look for the inside tail. Every tail tells a story. That's an inside tail, that's an inside tail, and then obviously there is one lower down right over there. Okay, you can see it lines up with another tail here. So that is a level. Now, if we come down to the 12 minutes, and let's focus on this turning point here. Okay, so through the day, you can see the trend is down, and the trend is down is giving you a couple of signals. Firstly, we are below the parabolic SAR, okay, and we are quite far from it. As we get closer to it, there is a risk that we are going to change. We also have the 9 and 27 pretty far apart. You can see there's a bit of divergence here. In other words, what I'm saying is the 27 is running in one direction and the 9 is moving away from it. And normally what happens is this kind of setup here. So they'll move apart and then it'll start rounding and then crossover. And there's many ways to trade on that. You can take on the crossover or alternatively take it off the level, which is kind of the thing that I would do. Okay, so let's just look at this. So you can see the trend is down, trend is down. There's never, here was almost a crossover, a bit of indecision here, but essentially what you would be looking for is a grouping of the oscillators to the downside, like this, and the Williams percentage R also to be down here, and I want to be at a level. Okay, so a level is always off a higher time frame. So if you look at this here, we're not off a level. Okay, so we're definitely not off a level. So there is a risk that it may turn here, but what you'd be looking to do then is pretty much just trade a break of those fractals. Okay, so you can see we broke down. We hit a level here. Now there are 3 levels in this area. We've got 200 moving averages. So we've got the 200 EMA, 200 SMA, and we have a level. But if you look carefully, let's just zoom in. Okay. If you look carefully, we didn't quite tag this level. And often when that happens, you may bounce off the 200 moving averages, and you can see the oscillators are kind of grouped to the downside here. So often it comes back to test this environment, which is exactly what happened. We came back to test, but we broke through and we hunted down two of the next levels. Okay, so always have the closest 3 levels when you're drawing your levels, because often you'll get a miss on the first one and then a breakthrough, then you're looking for the next one, and in this case it went right the way down to the 3rd level. Okay, I'm just going to zoom back out so we can get a bigger picture. So now if you look at this setup here, we have a number of signals. So what you're looking for is firstly a level. So we've got 2 levels down here. Okay, we're also looking for a grouping of the oscillator. So the 2 stochastics need to group in the downside like that, which is what we got off a level. Okay, and then we're looking for deviation from the 2 moving averages. In other words, I want the red one far apart from the blue one. Okay, you see they start off close and then we start falling away. Now what I'm looking at is price action. You can see the buyers are stepping in here with the tails off a level. So there's my confirmation that this is the right level. It's still going to be volatile, because you see how volatile it was, that eventually we rallied and moved off. And this was before the market opened. Okay, so 12. This is before the market opened. And you can see how we rallied. Again, you can see how the 200 moving averages hold up price. But that is a level, but it's a minor level. These are our major levels, which is actually what price is doing. Okay, and now you can see we're rallying, and we start getting pretty big bars. And when you get big bars like that, it's often exhaustion. So you can see exhaustion, deviation here. Okay, oscillators group to the upside. There's my cue with that red inside bar to get out of this trade. Or alternatively, start looking for a change in direction. So if we just go back to the 3 hour and we establish why it changed direction here. So you can see there was a level. Okay, and we'll look for the next one. Okay, there is one there. See, these all came to it. We missed it both times here. And there isn't really another level. Okay. So often what I will also do is put in these little inside tails here, although that's not a qualified level, but you can see it's sort of an ambush area. So in other words, what I'm saying is this top level here, which is the swing low, okay, which is a fractal, is my level. But then just look for, if you don't have another fractal close by, like we do down the bottom here, just look for tails, like here's tails, there's tails, and those would be your micro levels. Okay. Bear in mind that this was also a gap, which was a magnet, which we closed the day before, and then we rallied up again. Okay. And just while we're on the 3 hour, you can see what happens here. See how the moving averages are pretty much, they're not deviating, so there's no deviation at all. But look down here, there's a massive deviation, okay, and a grouping. Okay, so let's just get back to the 12 minutes. So now you can see this first level was blown through and we closed above it. Okay, so that's always a warning that that level's not really applicable. And then you've got those two levels to the upside. You can see we basically just flirted with this, dropped down, and then made a lower high, and then the profit taking happened. Okay, so your standard price action rules obviously will always apply. So levels are a key. What price is telling you within the candle, so that is an inside bar. Inside bar is a reversal pattern, and it's at a level. Okay. Now, so often what you do is you see a reversal pattern like this forming, then go down. You can even go to the hour time frame, and just confirm that there is nothing. You can see there's on the hour, you can see there is a swing low there, and there's another swing low there. So the hour and the 3 hour, 2 hour, those are the levels that you want to, areas that you want to take your levels off. I prefer to do the 3 hour. Okay, so it's either the 3 or the 4 hour on other strategies, but the strategy I prefer to use the 3 hour. Okay, so, and in this case here, because the first trade would have been a long, to be honest with you, I would have just been looking for an exit point. So my exit point would have been up here. I wouldn't have been looking for a short. And the reason for that is if we look at the 4 or the 3 hour, the trend has changed. We are moving to the upside. So I'm just looking for long entries because I'll take my trend off the 3 or 4 hour. And what indicates the trend? Moving averages and the parabolic SAR. Okay, now stop management. This is pretty key. So when you have an entry like this off a level, what you're looking for is you want to look to the left and you want to see where is the next swing low. So in this case, the swing low is down. Let's put a line on that. It's down here. Okay, that's at 25,568, and the last level here was 25,656. So you have a 100-point stop loss. Okay, so that would be my stop, my initial stop. Then as soon as we get going, the stop moves up to below the fractal, and then what you do is on every bar, you just keep moving your stop up below the parabolic SAR. Okay, so just in case you have the bottom or the top fall out the market for some stupid political reason or something like that, that way you can protect your capital all the way up, but have an exit plan, and your exit plan is pretty much you're looking for the level, and at the same time you want to see a grouping of the oscillators to the upside, and that's going to indicate my exit plan. Okay, so now if you look at where we've closed on the Dow Jones today, and this is a Friday, so we'll have to see what happens on Monday, but we've got deviation. Okay, we're just short of a level. There's a level. Okay, there's also a double top target, so here's my double top. There, you see there's the next top, and that target is pretty much just below this level. Okay, so is this a valid entry? I would say it's pretty close to a valid entry. I prefer it off a level, so back down here. possibly even all the way down the bottom. So this could be turning into a range. Okay, so you can see you're still looking at price action. But I do have deviation. I've started rounding. So, if the market was still moving, I'd more than likely take a gap, take a chance at an entry here and my stop below this previous swing low. Okay, and the only reason is I have a grouping. My oscillators are here. A little bit of divergence here, not much. But those are all signals, and I'm on a level. So I'm on 200 moving average levels, and I have another level pretty close here. Okay, so that would be a signal. Okay, so let's just have a look at another scenario here. What I'm looking for is you can see, just by me scaling through, you can see the turning points. Drop, look at price action here. I have a inside bar. I've sort of got this grouping of the bars here. Then I've got this massive bar that shoots past it. But I've got deviation, okay? And then you can see with this bar here how the SAR parabolic SAR sort of switches direction and comes to the bottom. I've got a grouping down here. I've got groupings here. Actually got diversions from there to there, diversions. Okay, and then let's just do that. Come to the 3 hour. And what we want to do is look, sometimes you've got to look quite far for inside tails. There's my inside tail. So where price was hovering in this area, that's my closest inside tail. Okay, if I go across, there's my next one there. Okay, and there's my next one there. And now you can see what price is doing in this area, and we actually dropped even further below that. Okay, so 12 minutes again. And let's just find where we were. Probably just draw lines there. Okay, so you can see right off a level, boom, and we rallied. Okay, so, and you can see my exit points. You can see there is an indecision bar. Look at my oscillators. Oscillators are all grouped. I cross over here, do form a bit of a flag, and then with a second push up. Okay, and there's always a second push. So first consolidate, second push. Sometimes it's a proper second push, sometimes it's just a little push. And this is typically coming to the end of the day. Okay, and what's happening with price action in the last couple of days is big up, big down, big confusion. So what you're looking for is the lower time frames to actually capitalize on making some of that money. Okay, the next thing I want to show you is a different scenario related to the stochastics. Okay, so just bear with me a second while I just find one. And again, as I'm scrolling, you can see grouping of the oscillators. Make sure that there's a level there, and look what happens. Okay, and even when there's news, so typically when you see news coming out, like non-farm payrolls or something, you'll see the chart setting up with something like this, and then all of a sudden you rally, or you'll see something like this. Okay, and I think this is a good example right here. So you can see we're here grouped in the buying, and the buyer stepped in. But if you look at what happened here with the stochastic, so firstly, Williams percentage R is in the sell zone, and then you have the stochastics that rapidly went up, but they turned apart. Okay, and when they turn apart like this, there's always a violent move coming. So when they group nicely together, it's normally it may be quick, but 9 times out of 10, it's kind of like a gentle meander up. Okay, I just want to find one where they turn apart on here. It's not something that happens often. So there's one there. So you can see my Williams percentage R is up. Okay, technically we've been in a downtrend on the higher time frames anyway, and what you're looking for is an entry point to continue to the downside, and here it is. Okay, so see these stochastics, they're quite far apart, and they cross over, and look how violent the move is to the downside. Okay, now I don't think I saw one on the hour just the other day. There we go. So here you can see there's two. So there is stochastics far apart. Okay, trend is up, but with this bar here you can see stochastics far apart. We're off a level. There was your entry was on a level. You've got the stochastics far apart, and look what happens. Violent move to the upside. Consolidation. Stochastics far apart. Williams percentage are not all the way down, but in the buy zone here. Also deviation from price. Okay, so it's diversion from price. See, that is pretty much a double bottom, whereas price is making a higher low. Okay, that's continuation diversions, and you can see we get our second move. What I mean by second move, that was my first move. I then consolidated down. Okay, there's my second move. What's my target? There's my second move there. Okay, was the swing low onto a level? Yes, it was. I've missed that level, but we pretty much had, you've got tails there, but if I look to the left, you'll more than likely find there's an inside tail, which is in that zone, and there's another one there. Let's just use these bottom ones here. Okay, so you can see sometimes it does turn in the middle of nowhere, but again, price action is key. So if I look at this scenario on the hour, you can see we rallied. It was a strong rally. I'm expecting a bit of a pullback, and then I'm expecting buyers to step in. Okay, and you can see how we had the deviation on the moving averages. They came together, and then we basically just rallied from way pre-market open. So this was in the before the European market even opened. Rallied. We found ourselves a level, and that level in this scenario was gap close. Okay, we found that level, came back, and then you can see buyers stepping in, stochastic quite far apart. Okay, looking for a level. Okay, and there are my three levels. You can see we bounced off this level and rallied with a pullback. Okay, so that's kind of the basis of it. What you're looking for is obviously groupings of oscillators, and then you need to look for your level. Make sure that you're on, you've got at least three levels which are pretty close to each other to gauge yourself off. Then what you're looking for is what direction are we trading in. So if you look at the 3 hour, you can see we're trading down. So during these 2 weeks here, I'm looking for shorts, looking for shorts, looking for shorts. Okay, when I get a break above the moving average and get a moving average crossover on the higher time frame, looking for longs, looking for longs, looking for longs. Okay, and a lot of times you can do long-term swing trading like this. So in other words, there was a long entry down here, and you could just leave one or two contracts for the ride while you basically trade other contracts for the short-term trading. Okay, now doesn't matter what time frame I use. Okay, if I look at the daily, let's just get rid of all the noise. Look at the daily. You can see we have a daily grouping for downside. We've got oscillator group there. We've got a level. Okay, and we've also got, so we've got moving average levels, but we've also got price action levels. Well, there's not one there, but that is a level that we'd be looking at. And where is there? No, I don't see another one. So just looking at the, obviously we're on the Dow Jones at the moment. I don't see a decent fractal level here, of which should technically hold up price. Okay, there was one there, but we've got through that, which lined up with our moving average. So we've broken through that. So now there's also a chance now, looking at price action, is for a second attempt at this level. So a second move down, build a base, and then rally, which will give you a double bottom. Okay, so price action is still your key. Levels are still key. Your oscillators here are just to give you the warnings that you need to start looking for something different. what I want to point out here, and specifically with the stochastics, you can get a scenario where the stochastics are grouped like it was the last couple of years. What's this, 2017? How, stochastics, all the indicators were grouped indicating overbought, be aware. But look what happened. We just continued with the moving average. Now you can see there's no deviation from the moving averages. They're almost parallel. Okay. You can see there starts a bit of a deviation here, but then we rally again. Even this scenario here, we got a bit more deviation, but you see it's a lot wider than it was here. And if you look at what we're doing now, you can see the deviation at every turning point. See it? Okay. And then here we've got another trend. You can see there's not much deviation. Okay, here we've got volatility again, big deviation. So when you're in a trend, an upward trend like this, the trend is up, so you're only looking for longs. Okay, until you get a proper trend reversal. And this here was looking like a trend reversal. You can see we were trending up. Look at the deviation there. And then you can see how oscillators just lining up, indicating time to buy, and off we go. Okay, so it's kind of difficult when you're in a strong trend like this. When you're in a strong trend like this, I prefer to use something like the Bill Williams or even the Ichimoku theory, because that'll get you going. But when we're volatile, like it's been the last couple of months, I'm looking for something that's going to help me pick the entry points. And you can see on the daily here, I've got deviation, I've got grouping, so there's a good chance that this short-term trend to the downside has now changed. I would expect it to come back because I always look for that pullback, and I'd like a deep pullback for another entry long, and that would give me the confidence for any of my swing trades. Okay, and as I say, any time frame, you can see the month, the weekly. Okay, you see, get a bit of deviation here, not much down here, deviation. Look at price action, lots of tails indicating lots of indecision. We have a grouping here, so there's still a chance for more indecision or a little bit of a move down or consolidation until we group. So we group something like this, and we have a decent trade. Okay, monthly, exactly the same. Can even drop down to the minute. Okay, and if you look there, deviation, groupings. Okay, so anyway, so that is the simple moving average. It's something that I really do like trading for, to get in the market quickly, and sort of just have a short 2 or 3 hour trade, get out of it, and move on with life. So it helps you stay on the right side of the trend as well, so long as you're using the parabolic SAR as your stop levels as well as your trend indicator or trend reversal. That is going to keep you on the right side. Your entry must be off a level, as well as you need a level plus stochastics grouped plus Williams percentage R grouped, and you're looking for deviation on the moving averages, and then you're looking for a reversal pattern. Okay, now I've got separate videos on the reversal patterns, the one that I look for anyway. I mean, there are hundreds of different reversal patterns, but I basically have 5. So I'll put a link in the description for that, and I'll also put a link in the description for the moving averages, sorry, the levels. Okay, so yeah, I hope that helps, guys, and if you do like it, please subscribe, give us a thumbs up, drop us a comment, ask questions. I'll try my best to answer them for you, and all the best for trading. Anyway, cheers for now.